Hi, good afternoon, everyone. My name is Min, and I'm the Director of Investment Research at Endowus. I have with me my colleague Yulin, one of our investment leads. She specializes in fixed income and is also the lead for our fixed income offerings. We are 2 out of 12 members of the investment office at Endowus. Next slide, please. So this is just a disclaimer for Singapore. We are required by regulation and our compliance department to pause on each slide to let you read so that you can take everything in. I'll just stop for a few seconds here. Okay, next slide, please. Next slide, thank you. We are also taking in questions during this webinar, so please go to this link that you see on the screen and type in the keyword here to access the Slido for the session. You can put in any questions that you want during this session or after during the Q&A. It's up to you. Next slide, please. A lot of people tuning in today are already familiar with us, but I understand there may be others who are new to Endowus. So here's a short introduction to Endowus, very short. We are a digital advisor and platform. Our mission is to give great conflict-free advice. That means we don't take any commissions at affordable prices. The investment office, which I'm a part of, and Yulin as well, works with our well-known world-class partners and fund management companies to give institutional quality and access to share classes that were originally only available to large institutional investors like the GICs of the world, but now they're also available to investors like you and me. So this is what we're trying to do, and that's our mission, to make investing affordable for everyone, like everyday people like you and me. Next slide, please. We are backed by some of the most well-known and respected companies in the world. All these companies that you see here on the page, they're all very familiar. Next slide. So now we can go on to the meat of the presentation, which is before we look at the present and perhaps beyond, let's talk about the past and reflect what happened in 2023. There were many significant events that took place last year, and I will just name a few. First, we saw the demise of a number of banks. Firstly, Silicon Valley Bank on the west coast of the US. Then we moved on to Europe with the takeover of Credit Suisse by UBS. We saw rate hikes and then pauses in these hikes. We saw the boom in AI and the rise of the big tech companies again. And of course, geopolitical tension and conflicts with the ongoing Ukraine-Russia war and the Israel-Hamas conflict. These are all, contributing to the volatility that we saw. How did the markets do with all this volatility? Next slide, please. Quite well, actually. With the exception of China and commodities that you see here, almost all the major asset classes and markets had a great fourth quarter and a really good 2023. These returns that you see on the slide are all in USD terms. So the US had a very strong year, as represented by the S&P 500 index on this chart. Europe, though not shown here, also did very well, along with Japan. The Japanese equity market did even better in yen terms. It returned about 28%, but gave some back when converted to USD. China, however, was not able to shake off the lingering effects from the property crisis, the slowing consumer demand, and the COVID restrictions. So even though the restrictions have been abolished, there are still some lingering effects. 2023 was a difficult year for China, the Chinese equity markets, even though GDP growth for 2023 was estimated to be around 5%. So that's still a really good number for a country. Next slide, please. Thank you. On this chart, you see, this is a chart that we show very often, which is the MSCI equity versus the value subset and the growth subset. So in terms of factors, growth companies continue to dominate value companies, both in the fourth quarter and in the 1-year period. This trend was consistent in both the developed markets and the emerging markets. As for the size factor, and by size factor, I mean the performance of large companies versus small companies, we saw that large companies in developed markets outperform small companies, while the reverse is true in emerging markets as EM small caps beat EM large caps by more than 13% last year. So that was a huge number, was a risk-on moment for EM. Next slide, please. And what was powering this growth in the US? And by some kind of by effect byproduct, the MSCI World, because the US market actually makes up about 60% of the MSCI equity. So after this horrible 2022, what we saw was the Magnificent Seven. So this is a collective term for 7 of these large tech stocks: Apple, Amazon, Google, or Alphabet, Meta / Facebook, Microsoft, Nvidia, Tesla. They declined in 2022 by an average of 46%, but there was a really strong rebound in 2023. The simple average of the 7 was actually 111%. So that's a very impressive number. And you contrast that to 55% return by Nasdaq and the 26% return by S&P 500. So that's the discrepancy is quite mind-boggling. However, the one thing to remember is, while these returns in their rainbow colors that you see on the chart look very attractive, it's very important to remember that these stocks are also very volatile. You would have to have the constitution and the stomach to hold these stocks through these big ups and downs, because you can't know when it's going to go up and when it's going to go down. So volatility works in both ways, either up or down. So for example, Meta or Facebook returned 194% last year. Just last year, it doubled. Not doubled, actually, it went up twice, but fell more than 75% from the peak. So if you were able to hold on when this stock fell 75%, and very few people would actually be able to do that, you would have made a lot of money. But of course, when you see your portfolio dwindling, you would definitely want to sell. So this has a lot of volatility. And in just over 3 years, it returned only 9%, which is less than S&P 500 or MSCI equity. And with that, that's the end of the equity review. I'll hand you over to Yulin for a review of the fixed income markets. Over to you, Yulin.
Yeah, thank you, Ming. Next slide, please. So at the end of 2023, if some people would remember, Chairman Jerome Powell said that the Fed would stay the course with rate hikes until the drop was done. Investors entered 2023 with very high expectations for the fixed income market, but it didn't quite deliver until the big turn in the last 2 months of the year. In Q4, during the Fed's last policy meeting of 2023, they finally delivered a pivot. Market quickly moved to price in future rate cuts, and this propped up fixed income return broadly, especially in longer duration assets such as global investment grade and global inflation-linked bonds. Global economy was slowing but continued to show resilience, especially in the US. So credit spread tightened further in Q4 2023, rewarding risky assets such as high yield. It is under this background that we saw fixed income markets rally in Q4. Sectors with higher credit exposure and duration exposure gained. Emerging markets debt, especially local currency market, led the way. This was followed by global investment grade and inflation-linked bonds. High-yield markets lagged in Q4 because of its shorter duration, but it ended the year being the best-performing fixed income asset class. Despite record inflow into cash and money market funds in 2023, fixed income assets ended the year with mostly beating cash, and in many cases by a wide margin. Next page. Now let's zoom back to a 2023 overview, examining one key driving factor of the fixed income market: interest rate. The key message that I wanted to deliver to you is that it is extremely difficult to time the market and the macro environment as an average investor. This message comes especially loud and clear when we do a post-mortem of the market and just see how many surprises it has delivered in just 1 year. The chart shows the evolution of US short-term and long-term yields from the beginning of 2023 to yesterday. Going through the rates market was like riding a roller coaster with 3 broad episodes. In the first quarter, the market experienced early worry of the US debt ceiling, driving yield up. This was followed by the blow-up of a few US regional banks, including Silicon Valley Bank, as Ming has mentioned already. Recession fear came back in picture, driving yields down massively, especially on the shorter end. In an environment where bad news is good news for the fixed income market, most fixed income assets, in particular long duration assets, performed well. Not a bad Q1 for fixed income. And maybe some investors would have thought a broader crisis is coming and Fed needed to pivot soon. Well, not yet. The second and third quarter proved to be a rather slow bleeding for fixed income market. The higher for longer narrative dominated. Fed proceeded with 2 more 25 basis point increase in Fed rate in May and July, bringing the effective Fed fund rate to a range of 5.25 to 5.5%. Coming into Q4 with dashed hope, fixed income markets rallied euphorically after signs of Fed pausing and pivoting in the near future. Yields came down drastically before giving back a little in January this year. Despite the year-end rally, the fixed income yields still remain relatively elevated versus historical level. JP Morgan summarized 40 notable events that helped shape markets this year. Both equities and fixed income markets have defied many people's expectations many times in 2023, and both outperformed cash in the end. As I said, it is extremely difficult for an average investor to predict and outperform the market in the short term. Now I will pass it back to Ming to talk about our portfolio performance.
Thanks, Yulin. Can we go on to the next slide, please? The next section. Great. Next one, please. Thank you. The flagship cash SRS portfolios all posted positive returns. You can see that both in the fourth quarter and also in 2023. The 100% equity portfolio had a good run, but it still trailed its benchmark by about 0.4%, while the 100% fixed income portfolio, and by that I mean the very conservative portfolio that you see on this slide, actually beat the Bloomberg Global Ag by 0.2%. For the 1 year, the 100% equity portfolio underperformed by about 1.8%, while the fixed income portfolio outperformed by 1.3%. When we talk about the 100% equity portfolio, I'm again referring to the very aggressive portfolio, the top one that you see on this table. There were structural headwinds. The portfolio consists of some index funds and also the dimensional funds. And the dimensional funds, as we know, have structural biases towards small caps, value, and that has been, those two factors have actually been detracting from relative performance. The portfolio overall also has a slight overweight to emerging markets, and that hasn't really helped since EM didn't perform well as relative to the DM last year. For the 100% fixed income portfolio, the outperformance mostly came about by the larger allocation to corporate bonds. So corporate bonds did better than sovereign bonds in the fourth quarter, and EM debt, especially those in local currency, actually did really well in Q4 as well, and that helped. So the portfolio's allocation to the PIMCO emerging market bond was a contributor to relative performance in the fourth quarter. With that, we'll go on to the next portfolio. Next, please. The CPF portfolios. Thank you. The CPF portfolios also generated positive returns. And before we go into the drivers of performance, I just wanted to actually take a minute to remind everybody that, with the CPF investment, you could just leave your CPF cash in the OA cash in the deposit. The guaranteed return would be 2.5%. But had you invested your CPF money in the very aggressive portfolio, and with that, I would just caveat that it comes with a lot more volatility, of course, than the guaranteed 2.5%. You would have made 17% last year. So investing often means that you have to take in a little bit of volatility because there is really no reward without pain, no gain, no pain. But if you are able to stomach that volatility, and that's something that you'll have to decide for yourself, it could be very beneficial in the long run in terms of growing your wealth. So back to the portfolios. The 100% equity portfolio lagged the broad global equity market by about 0.7%. The 100% fixed income, again, this means a very conservative, trailed by about 0.4%. In the 1 year period, that's 2023, the equity portfolio, 100% equity portfolio, again, the very aggressive portfolio, underperformed by 2.6% because there were various headwinds. And the fixed income portfolio did slightly better with a much narrower underperformance. The underperformance of the equity portfolio was largely due to the allocations to First Sentier Dividend Advantage Fund and the Schroeder EM Opportunities Fund. The Dividend Advantage Fund was hampered by its exposure to China, as we know, that did really poorly relative to the rest of the world. And for the Schroeder Fund, it was the team's stock selection in China. In the fixed income portfolio, what we saw was there was a slight shorter duration versus the benchmark, and this was helpful in the rising rate environment. But it was also a detractor in Q4 as, duration was a longer duration did better than shorter duration as yields came down. Next slide, please. We go on to the factor portfolios. The factor portfolios are powered by dimensional funds. So they all consist, the entire series consists of dimensional funds. And the dimensional funds have exposure to four factors for equity, which is the market, value, size, and profitability. And for fixed income, they have credit and term premia. So those are the factors that they're exposed to. And for the equity, you can see why it might have underperformed because the value and size, that all detracted. And in terms of fixed income, there was a strong performance. There was slight, actually for the year, the portfolio outperformed because of the strong performance from the Dimensional Global Core Fixed Income Fund. Next slide, please. Thank you. We'll go on to ESG. The ESG portfolios outperformed their benchmarks in the during the fourth quarter, but the 1 year period was much tougher. For the equity portfolio, having no exposure to energy really helped in Q4. But it also did well in certain stock selection like industrials and healthcare sectors. And then for the fixed income portfolio, the outperformance in Q4 was really due to credit exposure. But the positive impact was partially offset by the shorter duration because, as we know from Yulin's review, that shorter duration underperformed long duration in Q4. And we want to just remind our clients again that the companies in the ESG portfolios continue to demonstrate that businesses can also be responsible stewards and deliver positive societal and environmental impact. And we are actively monitoring these ESG data as they come available, and we hope to make them available to you down the line. With that, I'll pass you over again to Yulin to take us through the rest of the advice portfolios.
Thanks, Ming. I will start with income portfolio. So just a reminder that at the end of November 2023, we released a recommended portfolio changes to income portfolios. The objective was actually to introduce enhancements to the income portfolios through de-risking, further diversification, and cost reduction. Target payout ranges remain the same for all three portfolios: 5 to 6% for stable income, 5.5 to 6.5% for higher income, and 3.5 to 4.5% for future income, with the prospect of capital gain as well for future income. The performance update going forward will be for the new income portfolios, and it will also be against the revised benchmarks using a more credit-heavy fixed income benchmark, Bloomberg Global Ag Credit Index, to represent the fixed income component. So looking at Q4 2023, stable income portfolio delivered a positive return of 5.4%, despite underperforming the broader credit market. As being mentioned, the main driver of the relative performance was the short duration of the portfolio, shorter duration of the portfolio versus the benchmark as well, as longer duration benefited from the rally more in the second half of Q4. The higher income portfolio delivered a positive return of 5.2% in Q4 2023. It slightly underperformed the 2080 benchmark, and the relative underperformance came solely from the fixed income allocation driven by the shorter duration. The equity component of the higher income portfolio outperformed the broader global equities market. Currency hedging helped as Sing dollar appreciated strongly against US dollar in Q4. Additionally, the portfolio's tilt to real assets through the BlackRock Real Asset Securities Fund contributed as the sector rallied on lower interest rate expectations. Future income portfolio delivered a positive return of 6% in Q4. It also slightly underperformed the 40/60 benchmark, and similar to the other two portfolios, its fixed income component underperformed the global credit market, mainly due to its shorter duration. Its equity component also underperformed the global equities market slightly due to its allocation to the FSSA Dividend Advantage Fund. However, we believe that the fund's thesis and approach remain intact for the long term, and all three income portfolios are achieving their payout targets. So moving on to the next page, for the cash smart portfolio, they maintained positive returns in December and in the fourth quarter of 2023, and they all ended the year on a positive trajectory. Fullerton HGD Cash Fund and the Lion Global Enhanced Liquidity Fund, the underlying funds for Cash Smart Secure, which you can see on the first line in the table, delivered consistent positive returns each month in 2023, highlighting its stability. The funds have been able to capitalize on the rate hike cycle to offer attractive yields with dampened volatility. For Cash Smart Enhanced, it ended the year on a positive note as well, offering a slightly higher total return over Secure. This excess return over Secure reflected the additional duration and credit risk undertaken by investors via the allocation in the United HGD Fund, which is a short duration bond fund. And it performed favorably in 2023 despite headwinds in Asian credit. Finally, Cash Smart Ultra experienced more volatility throughout the year and endured 3 months of negative returns. We announced a recommended portfolio change in November for this portfolio to reduce both duration and credit risk. Despite earlier challenges, the Ultra portfolio achieved the highest total return among the Cash Smart suite in 2023, aligning with its investment objectives. Moving on to satellite portfolios. Next slide, please. So let's talk about China first, both the China equity and China fixed income portfolio. It was a challenging environment, as Min has mentioned, and both portfolios faced regulatory issues and manufacturing data headwinds in China. Taiwan, on the other hand, showed resilience with favorable returns, and Hong Kong struggled significantly, ending as one of the worst performing markets globally. So the China equity portfolio had a tough year, partially offset by gains in Taiwanese equities. However, the China fixed income portfolio rallied in the last 2 months in its investment grade segment, ending the year on a slightly positive note. Looking at the global real estate equities portfolio, it rebounded impressively in Q4, recording an 8.8% return. This was largely fueled by the market's reaction to a broader shift in monetary policy, with the BlackRock Global Real Asset Securities Fund outperforming its benchmark. However, the portfolio's geographical positioning and sector allocation slightly hampered its performance compared to its benchmark. The Megatrends portfolio benefited from the year-end rally as well, achieving a 6.8% return in Q4. Despite a positive quarter, the portfolio underperformed in 2023 against MSCI All Country World Index. There are a couple of reasons to that. Firstly, there is a limited exposure to the Magnificent Seven stocks, and there were macro challenges in healthcare sector and clean energy sectors. Both sectors the portfolio had exposure to. and there was an underperformance in the BlackRock Nutrition Fund. Moving on to the technology portfolio, it experienced a remarkable rebound as well in December, also driven by the market optimism because of the Fed policy pivot, which was actually quite favorable for growth equities. It closed the year with a significant gain of nearly 44%, although it slightly underperformed MSCI Equity IT Index, primarily due to its strategic positioning away from the Magnificent Seven stocks. Lastly, the low volatility fixed income portfolio performed in line with its benchmarks in Q4, with standout performances from Legg Mason Brandywine Global Income Optimizer Fund and the PIMCO Total Return Bond Fund in the two of the underlying funds within this portfolio. Next slide, please. So looking forward to 2024, we will examine a few major themes that might or might not impact the market. First, let's discuss monetary policy. Following 11 rate hikes in the past 2 years, we might finally see a downward trajectory in interest rates. According to the Federal Open Market Committee's latest projection in December, the median expectation is for 3 quarter-point reductions of the Fed funds rate in 2024. Market expectations, however, can differ from the Fed committee, with markets having priced in 4 to 6 cuts at various points since December. These expectations, however, are always evolving. The reality is the timing and the extent of rate cut will depend on 2 key factors: inflation and growth. Inflation has moderated to 3.4%, according to the latest print, a rather encouraging sign in the US. However, if reducing the last bit of inflation proves to be more challenging than expected, the Fed's ability to cut more aggressively and early would be limited. Similarly, the nature of the economic landing, whether it's a no landing, soft landing, or a recession, is a matter of debate. Market consensus fluctuates between a soft landing and recession. If the economy is weaker than expected, the Fed might also need to cut rates more aggressively and sooner. But the real question is, does the exact trajectory of interest rate cuts matter significantly for intermediate term or longer term investors? I would argue no. The real question investors should be asking is about their asset allocation. For instance, are you over-allocated to cash? Is cash still king? When interest rates drop, the return on cash will immediately decrease as well. Are you prepared for this reinvestment risk? Next slide. The chart shows you the return of global equities, global fixed income, and cash 1 year after the end of the historical hiking cycles, where available. In most instances, both equities and fixed income outperformed cash, with fixed income delivering more certainty. The provided chart shows the return of global equities. However, each period has its own dynamics and trajectory. For example, from 1995 to 1996, it was a higher for longer period, with the Fed maintaining high rates for multiple years. So during this period, fixed income marginally outperformed cash. But looking at 2000 to 2001, during the immediate cut due to the struggling economy and the tech bubble burst, equities suffered, but fixed income delivered stellar returns, outperforming cash by 5% in 1 year. I hope this provides some food for thought. And that's enough on rates. I will pass it to Ming to cover a few topics on geopolitics and artificial intelligence.
Great. Okay. Thanks, Yulin. So just looking at this chart, I think it's important to know that, the volatility is disturbing and it can be a little bit difficult during wars and conflicts and disasters. But the important thing here is that maybe, if you just stay invested, so if you calm down and just say that this is just for the short term and it's not for the long term, you will see that it will work out just fine eventually. So as long as your horizon is long enough, it's going to work out. So that's the main takeaway from geopolitical stuff and also from conflicts and wars. Next slide, please. Thank you. Here, it's really just going back to something that's top of mind to everyone. And this is really discussing the evolution of AI. I took this chart from Data Eco, so I just want to give credit to them. I didn't come up with this chart, but I thought it was helpful in illustrating how AI has changed over the years. It's actually going to be segmented into 4 parts, and I'll just go through it very quickly with just fun facts highlighted for each period. So the 1950 to 1980s was actually the foundations and early innovations of AI. During this period, AI was in its infancy. Sorry, it was when it was born. With theories being developed, and you have computers interacting with human language, and how just developing that model. So the focus was largely on creating systems that could mimic certain parts of human language and understanding. In 1950, Alan Turing, and you might have heard of him and the Turing test, he came up with the Turing test to set the stage for AI's potential. And in 1956 was the time when artificial intelligence, the term, was coined. So that was the formal start of AI as a research field. Going on to the next segment, which is the 1980s to the 2000s, this will be termed the rise of machine learning and internet influence. In this era, we see AI and natural language processing, NLP, begin to evolve a little bit more with the increase in machine learning and the advance of machine learning and the explosion of data from the internet. So this period was when more sophisticated AI applications were being developed using, stronger and more powerful computational ability and the availability of larger data sets. So 1980s were when the shift began towards machine learning. And this was really important. And in 1997, you may have read of this, is when IBM's Deep Blue defeated the world chess champion Garry Kasparov. Sorry, I might have butchered his name, but Gary K. Deep Blue defeated Gary K. It was a shocking, I think it was a bit of a shock to the world, which means that, the AI and the algorithm was actually able to defeat the human. Gary is a very smart man, was able to, maybe overcome the human ability to think. So that was a bit scary. And then the next period, the 2000s, where we have big data and advanced algorithms. In 2006 was when they had the term deep learning. And that really was to describe algorithms that enable AI to learn from large amounts of data. And the 2010s onwards, that's what we will term it the breakthrough and mainstream adoption. We have in 2011, IBM's Watson wins Jeopardy! Jeopardy! Is an American game show, and it showcased that the ability of AI to actually use NLP and come up with thinking abilities. And 2015, Google had this AlphaGo, which was able to beat a professional Go player. 2010s, we started to see virtual assistants, and this is when AI got incorporated into daily life. So we started to see virtual assistants like Siri, Alexa, Google Assistant. I don't think it has a name. Became household names, being integrated into daily life for us. And then to the 2020s, which we are in right now, we will term it the age of ChatGPT. And OpenAI introduced ChatGPT in 2022. It's a variant of generative pre-trained transformer, that's GPT, revolutionizing the way AI understands and generates human language. So I thought this was very interesting, and I hope you found it interesting as well, which brings me to the next slide, please. Thank you. Here is, you can just digest this for a second, and It's really just to show that the way we've communicated and live have been really changed by AI. ChatGPT, you can use it for writing professional email, maybe. You can use it to power chatbots that can come up with quick and accurate responses. You can also use it to analyze large chunks of data. It provides insights and analytics, and that will help you with making informed decisions. And on the other side of the spectrum, you also have artists and writers using AI and ChatGPT for inspiration and creating content. So I think there was some controversy when AI generated photograph actually won a photography competition. It was like, is it right? So I think that was interesting that it was able to beat, like human creativity to win that. And the chart you see here actually illustrates the fact that the world is very easily adopting and adapting to new technologies, even more than before. So while Netflix took a few years to reach 1 million users, Facebook slightly less than a year, Instagram a couple of months, maybe 2.5 months, ChatGPT took 5 days to reach 1 million users. So that's astounding to me. Next slide, please. Thank you. And so apart from the impact on our everyday lives, how else would AI affect us? In many ways, but some we may be able to guess, but there may be impact in other ways that we can't even imagine right now. So the chart on the left shows that most jobs in advanced economies are exposed to AI. And the emerging markets and the lower income countries see less of that exposure. So these two charts and data is actually from IMF, so I didn't make it up. AI could also affect the income and wealth inequality within these country groups and within the countries themselves. So there could be polarization within income brackets. So for workers that are able to use AI to make themselves more efficient, more productive, they could see higher wages, working less. Whereas for workers who are not able to harness the power of AI may fall behind. So that's always that risk. So there's something to consider for countries to make sure that they are adopting their policies to incorporate AI adoption. The chart on the right actually shows the preparedness of each group of countries. So the advanced economies, EM, and the lower income countries. The advanced economies are the red dots on the top right-hand corner. And it just shows that, yes, they are more affected by AI, but they are also most prepared to tackle the effects of AI and what comes with it, all the hairiness, regulations, the moral dilemma, everything that comes with it. So they're more well prepared. So it's just to show that, the world is indeed changing. It looks like all this might be a while away, but the fact is that AI is here. The era of AI is here. This is not a crystal ball reading by me or by Endowus, but we should expect to see more of this being played out this year. While anything AI related in the markets will continue to be chased by investors, we should also remind ourselves that there is massive volatility associated with these stocks, these few loved stocks, and that most, if not all industries, should expect to benefit from this AI adoption. And it won't just be isolated to the tech industry and some of the other subsectors within it. That's what I have for markets outlook. Next slide, please. So just to end it off here, here's a chart to show you what you can choose to do with your money. The first, you can spend it, you can save it, you can speculate. But at Endowus, we advocate investing because that is the best way for you to grow your wealth for the long run. And thank you very much. Now we can move on to the Q&A section.
I'll let Ming take a break and I'll take a few questions. I saw that one of the most upvoted question is on the comparison between corporate bonds and sovereign bonds. Which one do we see more safer upside? And also, where do municipal bonds sit in between corporate bonds and compared to the corporate bonds and sovereign bonds? So For sovereign bond, the main risk exposure that you will have is actually interest rate risk, and this drives most of its return. Whereas for corporate bonds, you are taking on additional risk, which is the underlying company's credit risk. And generally, what it means is that if there is no change in interest rate and if everything stays the same, including the economic fundamentals, and if there's no default for both bonds, there will be a premium because of the additional risk in corporate bonds compared to sovereign bonds. However, if, for example, economy worsens, right, and companies default rate goes up, this will definitely affect corporate bonds more than sovereign bond. So if you are thinking about upside, I guess the scenario that you are thinking is, for example, there's a rate cut, which will be beneficial to the price of bonds, and this will benefit both corporate bond and sovereign bond. However, usually when the rate cut happens, it means that the economy is probably slowing down, and this might mean an increase in default rate, which will then negatively affect corporate bond. So relatively speaking, if you are just looking for a safe place to invest in fixed income, definitely sovereign will give you that kind of protection and upside from the duration exposure in case of interest rate cut. Where does municipal bonds sit? Well, just in the context of US, it will sit in between these two fixed income segments. Muni bonds, for those who don't know it very well, because it's relatively niche, are the bonds issued by US states. So generally, these are issued to fund different infrastructure projects. For example, hospitals, toll roads, and it will be, so how they pay back the coupon and also the principal is either through the tax from the state or from the revenue of those projects. Like people pay for the toll road, and this will go back to the investors eventually. It's interesting. It's actually a quite interesting sector to look at if you know it relatively well. It's long duration, and because it's relatively high credit rating, it is a high quality long duration assets to hold if you are expecting rate cuts. One last thing I would like to say is in Muni, there is also investment grade and versus high yield. So it's something to differentiate as well when you look at this asset class.
Great. Thanks, Yulin, for taking that first question. Maybe I can just answer the most upvoted question here, which is there still a place for active management of equities? Considering most active equity managers underperform passive ETFs and funds. So this is the active versus passive debate. We at Endowus, we believe that there is room for both. Passive index tracking funds are very helpful for low-cost, broad exposure to asset classes. You can think about the MSCI World, for example. If you don't want to choose which countries or segments that you want to focus on, you can just buy the Amundi or iShares MSCI World Index Fund, and that would be very helpful. However, for active management, if you consider some of the places, or not places, but asset classes or segments of the market that are a little bit less researched and under-researched, under-covered by analysts, and also that do not have as much capital flow. So efficient markets, it makes sense to have passive exposure, but also less efficient markets. That is where, if you are able to do that research, you may be able to uncover some alpha. So you will be doing better than had you just bought the entire market. And some of this where we can see is probably in, say, the frontier markets, where the MSCI frontier market has about half of its weight in financials. So do you really want to have half of your portfolio in financials? Maybe not. So this is where an active manager may be helpful to come and maybe pick out just the best of those financials and also have a diversified exposure to the rest of the market, because not all indices are equal. Some are maybe more concentrated than others. So that's something to consider. Yulin, would you like to take the next question?
Yeah, there's one question on not all bonds are doing well. I think this person probably had a bond that had a drawdown of 30%. The question is, should you sell and take the loss, the unrealized loss as of now, or keep holding it? It really depends on your situation, I would say. And I think the first point I want to say is the fixed income market exposure that we have in our portfolios. And also, the update that we gave is about the broad market exposure and its return. It really emphasizes the importance of diversification, because you can, of course, pick a bond with like poor fundamentals. For example, if an investor was invested in a Chinese property bond, then the drawdown is probably 50, 60, even 70%. I think the question of whether to hold it or not, if you don't see any problem of the company or the issuer repaying the debt in the end and servicing its coupon, then it's okay to actually stomach the volatility and hold it until it matures. But given the drawdown, I guess there is already heightened concern in the market towards its ability to service the debt. Something that you should consider. And it's always to actually invest in a more diversified portfolio eventually. Yeah.
Okay, thanks, Yulin. There is a question on how, the question says, how can Endowus say that we did well when many of our funds did not beat the market indices? Actually, maybe just to clarify, I'm not sure if the person who wrote the question is talking about FundSmart in particular, because that would be different indices. So for example, the China funds are definitely not going to beat the S&P 500 because, as you know, China underperformed the US. So this is a little bit more difficult to answer. So I would ask the person who wrote the question to reach out to our client advisors, and we'll be happy to maybe discuss further with you over the phone or over email. I think that might be easier, so we can understand more this question, whether you're talking about which particular fund you're talking about, actually. And then Yulin, would you like to answer the next question, or I can take one more too?
I just want to make a comment here, because I see a lot of people asking about our views, very short-term views actually on the market. For example, the next most popular question is bond versus equity. What is the trend for the next 3 to 6 months? It is extremely difficult to say, and I wish I know myself as well. And there's a question on, I think, a view on ESG, our view on ESG portfolio. Again, it's really difficult to tell, when the tide will turn, because there was some headwinds for ESG portfolio. For example, renewables didn't do as well. The clean energy theme, I think, suffered in 2023 and had a lot of volatility. What we can say is that ESG is definitely a secular trend. It's a long-term trend that hopefully in the end will be priced in and reward investors. But when it will be priced in is very hard to tell.
Okay, thanks, Yulin. I can take this one on when. So the question is, when are we introducing a passive tech fund? So the person has been waiting, and I appreciate that. Thanks for writing in and waiting. We are waiting as well. We've been working with a number of our fund management company partners to introduce a passive index tech fund here. It's challenging because in order to introduce a new product, they have to do market research, etc. So we are not sure when that's going to happen, but this is something definitely that Endowus and the investment office has been working on, and we will keep you updated if that is possible, when that is possible, and what we can expect. But in the meantime, we do have a tax satellite portfolio, and that's a very diversified global portfolio. So it's not just exposure to the U.S. tech market, but globally. So you can have some of the great companies that are in Japan or Korea or Taiwan or even in Europe. So that's probably more diversified. You may not be able to see the 111% that the Mag 7 has returned, but you can definitely have a lower volatility because of the greater diversification. And just going on, I believe we've already answered most of the questions. Yulin, do you see anything else?
Yeah, I want to address this question. I am investing for 10 to 15 year horizon. How do this year's themes impact my investment decision? First of all, I want to say congratulations. I think actually, given that the yield has come up, it's a really good time to start investing, because the expected return, for example, in the fixed income market is definitely higher than, let's say, 2 years ago. And in terms of how you should position your portfolio for this long horizon, I think fundamentally we also have to potentially have a deeper conversation with you to understand your risk tolerance. I would say that if you have a longer time horizon, you can stomach much more volatility than those with a shorter time horizon, but it still differs from person to person. Actually, what our advisors can do is to figure out your expectation for this portfolio, right, after 10 to 15 years, and come up with a holistic asset allocation plan for you to reach the goal. It's always good to have a goal in mind when you are thinking about investing, and figure out how much return you need and how much risk you can stomach, and see whether those two metrics reconcile before we go into the detailed asset allocation. I also saw a question. Right. Okay. On the first date, if it is a dividend advantage fund, because I mentioned during, I think, one of the commentary that I gave, that we are still convinced by the fund's thesis. Yeah, I think our advisor already gave kind of a answer to this question. Sorry. But I just wanted to say that actually they also published kind of explanatory piece on their own website, and it's worth for you to go and have a read. It explains their underperformance very clearly last year, and it's actually because of their preference to higher quality Chinese companies. But last year, actually, the lower quality state-owned companies in China rallied instead. So I think from a fundamental perspective, it makes sense. And actually, they have been using this market weakness window to add on to their high conviction names. I think when we look at a fund manager, it's hard to tell how they will do in the 2 to 3 years. What we do is that we monitor them on an ongoing basis, and we try to understand their performance and see whether it stands up to their process, and whether it is actually rational and explainable. So yeah, I hope this helps.
Okay, so I think there's just one last question, which is, can I find Nasdaq fund, I guess, in FundSmart? So we don't have a fund that's tracking the Nasdaq index right now in FundSmart. I think mentioned earlier, we are trying to get some of our fund management company partners to launch an index fund here potentially, but we'll have to update you on how those conversations are going down the line. So I think that's all we have in terms of questions. Thank you so much for tuning in during your lunchtime.